Today is Wednesday, July 7th, 2021, and thank you for joining me for another edition of the Market Commentator podcast. My name is Jake Wilms. I am a quantitative analyst for the Milwaukee Company, and joining me as usual is my co-host and father, Andrew Wilms, the president and CEO of the Milwaukee Company. Thank you for joining me.
Well, thank you, Jake. Always a pleasure to do this with you.
It's been like 2 weeks since we were back on a podcast, I think, or even three, because we had a couple where I wasn't on and then you weren't on, and so
yeah,
nice to have you back on the show with me.
Yeah, it's nice to be together again.
Today, I'm going to be asking Andy some questions about the stock and bond markets and how they did in the second quarter and our outlook for quarter three. But before we get started, please keep in mind that this podcast is for informational purposes only. The views expressed today are my and Andy's personal views and not necessarily those of the Milwaukee Company. And with that out of the way, let's begin. We can start with taking a look at quarter two numbers. So would you be so kind to give a quick rundown for our listeners about how markets were in quarter two?
I'd be very glad to do that. Overall, I'd say it was a very solid quarter for the stock market. And while the bond market did an admirable job of trying to cope with the fears of rising interest rates and higher inflation, for the second quarter, the Dow was up about 4%. The NASDAQ was up about 7.5%. And the S&P 500 was up about, just under 7%. And, both the S&P and the Dow have now put together 5 consecutive quarters of positive returns, which is the longest stretch like that since 2017. And the S&P 500 enjoying nearly a 20% gain for the first half of the year.
All right. Sounds like stocks did quite well. What about the bonds?
Well, the bond market has become surprisingly quiet, I would say, in the past few months. The 10-year, which is sort of the bellwether for the bond market, the 10-year Treasury yields peaked at 1.74% back on March 31st, but since then have fallen back a bit. Most recently, the 10-year has kind of settled into this narrow trading range centering around 1.5%. And, it seems for the time anyway, at the moment, that Mr. Market appears to have kind of shrugged off concerns about inflation and, worries about rising interest rates and uncertainty about the direction of future fiscal and monetary policies, I should say. It seems as though the market believes the Fed when it says that it won't be raising interest rates anytime soon. The current rates that we're seeing now still represent a steep rise from the below 1% rates we had for the 10-year when at the start of the year. So we're kind of treading water at the moment. There's a lot of uncertainty. For the year, we're up still significantly.
Let me ask you this. So what do you think were some of the key drivers in quarter two that led to the performance on the stock side? And I know we talked about what some of the reasons for the bonds, why they were kind of lagging, but what was driving that performance for stocks?
Well, it depends on the number of factors. First of all, of course, you had the coming out of the COVID-19 pandemic and the increased vaccination rates and the reopening of the economy. Not surprisingly, did a lot to booster the economic recovery and corporate earnings. And so higher corporate earnings added, support for the stock market. You also had the situation where the Fed continued to spend a great deal of money, and inject a great deal of money into the economy, both the Fed and the Congress. And all this money, has to find a place to land. And the stock market was a beneficiary of a good deal of that, money and increased money in circulation. And then you had talk about another possible major infrastructure bill, which was positive for the market, although, the outlook of that is somewhat uncertain. And you have the prospects for trillions of dollars of additional spending for social programs, which would also, I think you see a lot of that trickle down into the stock market. And finally, you have a situation where the Fed has been steadfast in its prediction or in its promises, I should say, to keep interest rates lower longer. They've been holding down at least the short end of the yield curve, and that's been positive for bonds. So and inflation has seemed to slow down, or the outlook for inflation is for it to slow down and be only transitory. At least that's what the Fed is claiming, and so that too was a positive for the bond market.
Let's get out our crystal balls maybe a little and see what lies in store for quarter three. What do you think about the bond market?
Well, my crystal ball is not any clearer than anybody else's, and maybe a little foggier than most. But I would tell you there are two widely divergent schools of thought on the outlook for the bond market in the second half of the year. The bond bulls believe that fears that the Fed will be forced to raise rates sooner than it intends to combat inflation are overblown, and that the Fed can successfully keep rates lower for a long time, and that inflation will in fact be transitory. But you have another school of thought that is just as adamant that the bond bears, so to speak, and they think that this unprecedented level of fiscal stimulus that's already in place to boost economic growth and the Fed's willingness to tolerate higher inflation in the short term are reasons why bond yields will move higher in the second half of the year. And as you know, Jake, when bond yields go up, bond prices fall. They're negatively correlated.
Mm-hmm. Okay, so where do you stand? Which side are you on?
Well, I put little stock in predictions of what's going to happen over the next few months, and including my own. But that said, since you have asked me, I'll tell you that I think, for what it's worth, that short-term interest rates should remain, anchored around zero by Fed policy. I think the Fed can successfully keep the short end of the yield curve near zero. But it's going to be more of a struggle for them to do that on longer dated maturities like the 10-year. And I could, if you forced me to make a prediction, I guess I would say I see the 10-year yields rising to a 2% to 2.5% level by year's end. And I'd also say, Jake, that it's very important to keep in mind that market expectations for inflation over the next 10 years average around 2.5%. Okay, but the yield on the 10-year right now, as we've talked about, is about 1.6%. So that means that 10-year rates would have to rise by 90 basis points, or better than 50%, just to keep pace with the expected rate of inflation. So in other words, the break-even point would be, of yields moving up by that much just to break even with inflation, if the inflation predictions prove to be correct. So in other words, if inflation expectations are reasonable, then it would seem bond prices could suffer a serious decline in the months ahead.
Wow, okay. I like putting it that way. It really puts it in perspective. That's unfortunate
I would say
for the bond market. But
well, I'm not saying people should bet the farm one way or the other, but I would say the downside risk for bonds are much greater than the upside potential right now. But then again, I would also tell clients, this is another reason why our listeners, I should say, this is another reason why our listeners might want to consider, aren't really going to be adversely affected as much by this if they hold on to the bonds until maturity. In other words, yeah, they might see the value of their bonds decline in their portfolios, but they'll get what they were expecting to get if they hold on to the bonds until they mature, assuming the bonds don't default. The riskier area for me right now, and what we're trying to, by and large, stay away from, is the longer duration bond ETFs. These perpetual ETFs that do not hold on to bonds until maturities, but target a certain duration or time to maturity, like 10 years or whatever, 7 to 10 years is an example. And those bond ETF, their prices will drop if bond interest rates do go up. And unlike a bond, they don't have a maturity date, so you can't say with certainty whether or not you'll ultimately get your money back, and the prices will ultimately rise in the future.
Let's switch up our focus to stocks now, because that's the other half of the market we've got to pay attention to. And what do you think about where the stock market is going from here? Similarly, how you answered the bonds.
Well, if I sounded wishy-washy on the bond side, I have even a lower degree of conviction on what the stock market will do over the next few months. Well, I can say I think bond risk is elevated, and it might be a good time to avoid long duration bond ETFs. The stock market is much harder for me to make a call on, and the reason I say that is because we all know the economy is doing great. And it's doing much better than about anybody could have predicted this time last year. And corporate earnings are much higher. A large percentage of major corporations who have reported their earnings have reported earnings that exceeded expectations. So that's a very positive for the market. But on the other hand, stocks are very expensive right now for historical standards, because I think a lot of that good news has already been priced into stocks. And so, and of course, as stocks become more expensive, there's more risk of a correction. So if history is to be your guide, you'd probably say there's little room to the upside for stocks, and also a whole lot of room to the downside, sort of similar to what we were talking about with bonds. But while I wouldn't make a big bet one way or the other, I think the most likely outcome for the remainder of years is for stocks to continue to drift higher. But I would say that upward drift is going to be accompanied by be slower and be accompanied by more volatility. And even though I have a sort of a positive bent towards stocks, I would tell you that I'd be very cautious about adding more risk to investment portfolios until the picture becomes clearer.
Okay, yeah, I think I would agree with that for the most part. I think it's difficult to justify adding risk to a portfolio when there's a lot of uncertainty in the market right now. So I definitely agree with you there. But let's wrap up the podcast with any advice you would like to share with our listeners for the rest of 2021. Specifically, I would say focusing more on how our listeners should respond to all this information, what the takeaways should be.
All right, well, I have 3 takeaways. First, I would remember, listeners, that while the future is always uncertain, I would say the range of plausible outcomes is particularly wide at the present time. Secondly, I would encourage listeners who expect that they will have a need to withdraw significant money from their portfolios in the near future. I would suggest doing that sooner rather than later. And yes, it's a bummer to pull money out of the stock market only to see it move higher after you've done that. But it's much worse, in my opinion, to be forced to sell stocks when you need money, and that sale has to occur after a major drawdown. And so I think both are realistic possibilities at this time. And the third thing I would say to clients or to listeners, excuse me, is to make sure that their portfolios are very well diversified. And not only on an asset class level, but also on a strategy level. I mean, we all know you should continue to own both stocks and bonds and different sectors of the stock and bond market. And that's what, asset diversification is all about. And you and I think, Jake, are both believers in that. But I think what a lot of people overlook is the need to diversify on a strategy level. And that's what our whole core satellite approach is about, where you have a core portfolio that's passively managed or is designed to capture what's called market beta. Take what the market will give you. That's sort of your core. And then you surround that core with tactical asset allocation strategies that try and adapt the portfolios that being managed by each of those strategies in response to what's happening, or I should say in response to economic and market data. And I think it's very helpful if those tactical strategies, you have more than one of them. So you have tactical strategies responding in different ways to different sets of data. So that I think is a very important and becomes increasingly important now because of the high level of uncertainty. You don't want to put all your eggs in one basket. And so you don't want to use just a single approach to, I don't think, a single approach to investing your portfolio.
Well, that about wraps it up. Thank you, Andy, for all the great information about Q2 and what to expect moving forward for the rest of the year. Please keep in mind, listeners, that you should conduct your own independent research before acting on any information or opinions expressed during this podcast, and that you should not act on anything you have heard in this podcast until you have discussed it with a qualified financial professional who's familiar with your personal situation and investment objectives. And I'm going to one more time remind you guys to, if you're listening on YouTube, to please hit the like and subscribe button, leave a comment. It helps a lot. Appreciate it very much.
Great. Thanks, Jake.
All right. Have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.